Welcome to the chart patterns module. Now, on a stocks chart, there are patterns that when you can recognize them, it could really increase your chances of having a winning trade. So let's go right into it. Chart patterns. The first one we have is a bull flag. Now, bull flags, they can be spotted during an uptrend on a stocks chart. Now, they can be great entry points to buy call option contracts. You see a flag right here. Now, the flag's pole, this resembles the uptrend. The flag itself resembles the slight pullback. So you'll have an uptrend, a slight pullback in price, and then the uptrend will continue from there. And we view these as high probability setups. All right, now during that uptrend, you can have multiple bull flags. All right, so let's move forward and look at a chart. So we have NVIDIA's chart, and we had a downtrend starting right here on the left-hand side. We had some structure points that were formed as well during that downtrend. But then we get down here to the bottom, and that flagpole forms right here during the beginning of the uptrend. And here's the pullback. Here's the flag. So we draw lines. When we have the uptrend, we wait for the pullback because we never want to chase an uptrend. That's called what? Do you remember in the definitions what it's called when you chase an uptrend? FOMO. If you said FOMO, fear of missing out, you would be correct. So we want to wait for pullbacks. So here is the pullback, and this is a bull flag. So now we draw our lines as the flag is forming. One line at the bottom, one line here at the top. So this is our flag. When we get a nice solid green candle that breaks above the upper line of the flag, that lets us know that the uptrend will likely continue. So that was this candle right here. This gave us some confirmation that this uptrend will continue. Now also pay attention right here to this flagpole. This green candle closed above this point of structure. All right, so that was good to see as well. Then the uptrend starts, the uptrend continues right here. We get to this candle, and this candle closes above the peak of the pole, this area right here. This candle closed above it. So this is viewed as structure as well, the top of this flagpole. So that's a good candle to see, and it also gives us more confirmation that this uptrend will continue. This candle here closes above this structure point, which again gives us more confirmation that the uptrend is going to continue. So when you see the bull flag forming, your entry will be for call option contracts. Now, entry-wise, this candle would have been a good point to enter for those call option contracts. Once this candle closed, you could have taken positions right here for call option contracts. And as this uptrend continued, you would have been making money. All right. Now, another example of a bull flag. Price action came down, it bottomed out, then you see the uptrend starts. So here is the flagpole, here is the flag itself, here is the pullback. We draw our lines, our first line at the bottom, second line at the top. So we make our flag, and then we wait for a candle to push through the upper line of that bull flag. This gives us confirmation that this uptrend is going to continue. For example, let's say this wasn't a red candle, but you got this wasn't a green candle, but it was a red candle that closed below the lower line of the flag. At that point, we don't know that the uptrend will continue, and we don't take positions for call option contracts. We only take positions for call option contracts if we see a solid candle close above the upper line of the flag. All right, and again, we see this candle here closed above this structure point and this structure point. This strong green candle closed above this structure point. So all of this gives us confirmation that the uptrend is strong and it will continue. Now for a bear flag, it's just the opposite. You spot bear flags during a strong downtrend. We have a flag here, but it's upside down. That's because the pole now is resembling a downtrend and the flag is resembling a pullback. So again, these are high probability setups, and we look to get into put option contracts when we see a bear flag forming. And also, there can be multiple bear flags during a downtrend. Let's take a look. So here is a chart, and we see the downtrend starts up here at the very top. So you can see the flagpole is right here, and then we get the pullback. So we draw our lines. As these candles form, we draw a line at the top of these candles and at the bottom of these candles. This forms our flag. So now we have a nice bear flag here. This candle right here, this solid red candle, broke below the lower line of the flag. When we see this happening, this is confirming the bear flag. All right. Now, it's important to note this is a point of structure, and this candle right here closed below this point of structure, which just gives us more confirmation that this is a strong downtrend and it will continue. All right, so this is a bear flag. It's just the total opposite of the bull flag. Let's take a look at another example. Here we have 3 bear flags. We come down in price, get a slight pullback. This candle breaks below the lower line of that bear flag. We come down some more, we get a pullback. This candle right here breaks below the lower line of that bear flag. We get another pull down, and then what happens? Just a pullback right here. The flag forms again, and then we go down in price more. So you can have multiple bear flags, you can have multiple bull flags, but we want to take entries after the flag is confirmed, and then we get extra confirmation with a bull flag when a candle pushes above the upper line of the bull flag, or when it comes to a bear flag, we want to see a candle break below the lower line of the bear flag. All of that gives us confirmation. All right. A double top formation. Now this resembles the letter M because we go up in price, the first top is formed, we go down, we come back up, and then the second top is formed. So with this double top formation, we're going to have 2 peaks, and you can see this happen on all time frames. Let's see how it looks. All right, Tesla, we have a nice double top formation, and if you look over here, it does look like the letter M because you have a peak here, the first peak. Price action comes back down, and then it goes back up here to form the second peak. Now, when it came down these 2 times, it forms what's called the neckline. So it's kind of a level of support, but we call it a neckline. All right, so when price action bounced up for the second time from the neckline, it came back down to the neckline here. So to confirm the double top, we want to see a candle close below the neckline. That happened right here on this candle. So you can take an entry for put option contracts when you see this candle form. Or some traders, what they'll do is they'll wait for a retest of the neckline. So they'll wait for price action to come back up to the neckline and then reject to the downside. So it just depends on what you want to do and how safe you actually want to play it. Because as you can see, it never retested. Price action just continued to go down. But there are times when a retest does happen. So just note that. Make that note. A retest is likely in a lot of situations when it comes to support, resistance, double tops, retests. They happen very often. All right. So as you can see, if you would have gotten in this area, you would have made money as the price action went down. So this is a double top formation, and it's a really good setup to be able to spot. All right. So what we're going to do now is we're going to go into a video about the double top formation. So I want to go over really quickly on the double top and when do you get out of this position. If you get into a double top play, how do you know when to exit and close that position to take profit? All right, so let me give you a tip on that. What I did here, as you can see, we have our double top, and all I did was I drew a line straight across from the first peak to the second peak. Then I took my line tool and I drew the line from the peak of the double top down to the neckline. So that gives us the distance that we're going to need. All right. Once you establish this line and get the distance between the peak of the double top and the neckline, all you're going to do is move the line down to where the top of the line matches up with the neckline. And that's what I did here. These two lines are the exact same. So you always want to mark your neckline and mark the peak of the double top. Once you do that, you can get the distance between these 2 points and then move that line down here and connect the top of the line to the neckline. Now you have your distance that you can expect the drop to be. This is the expected drop distance. So if you get in your position right here, once it breaks support or breaks the neckline, you can expect it to go down about this far before it possibly shoots back up, which it kind of did right here. And if you look, the bottom of this line matches up almost perfectly to the bottom in which we started to go sideways and we went back up. So if you would have got into put positions, you would have made money as the stock went down. But if you would have still been in that put position, you would have started losing money as the stock went back up. So to play it safe, when you get this distance established, you can look to close your position once you get down to the bottom of this line. Once price action goes down and you get into this zone here to the bottom of this line, look to close your positions. Now you may say, well, hey, it went back up and then it went down more, so I could have made more money in my puts. Well, true. However, you don't want to take that risk. You want to play it safe, take your profit once you get down into the zone in which you establish the distance in between this double top peak and the neckline. You bring that line down and look to take profits once you get into this area. So I wanted to go over that really quick, just so you'll know when you can look to exit your position and just about how far you can expect the drop to be. All right, so here is a double top on Lowe's companies. We have the first peak right here. price action comes down, back up, back down, and then back up. So at this point, we have our neckline. And then here, we had a breakthrough with this red candle. It closed below the neckline. Now, I wouldn't have entered on this candle. Now, when this one came, this one was considerably lower than the neckline and could have been a good entry. But again, some traders like to wait for a retest. It didn't happen right here. But again, sometimes it will, and it'll come back to the neckline and then head to the downside. So as you can see, when you spot these double top formations, they're pretty good. And when you get to breaking that neckline, there's a really good chance, just like in this example, in the previous example, that price action is going to continue to head to the downside. Okay, moving right along, we have a double bottom. Now this resembles the letter W, because instead of the two peaks being at the top, you have two bottoms, the first bottom and the second bottom. All right, you also can see this on all time frames. So let's check out the double bottom. All right, so here price action comes down, forms a bottom, comes back up, right back down into the same area, and then heads to the upside. So at this point, you draw your neckline. All right, these 2 points right here helps form the neckline. So we get a break to the upside. Now you could have entered right here or even right here because we broke resistance. All right, we broke the neckline to the upside. So you could have entered here, which wouldn't have been a good entry, but some traders would have. Or you could have entered right here in hopes that the price action was going to continue to go up. But as you see, remember I talked about the possible retest. It came back down to retest the neckline and then went to the upside. So I wanted to show you this example because a retest happened. All right, so some people, they wait for the retest and they would have gotten in on this candle. So they would have had a better price and they would have made more money than the person who would have gotten in on this candle. If you would have gotten in here for call option contracts, you would have actually been down a bit because price came down. But if you got in here, you would have had a smoother ride to the upside. Okay, so now we're going to jump into a video that's going to talk about this double bottom formation. All right, so we talked about the double top and when you can look to close your position when you are in a double top play. Now let's look at the double bottom. It's going to be the same exact thing. So what we're going to do, we already have our neckline drawn. Okay, now instead of the peaks, we're going to draw a line across the bottoms. We'll take this tool here and we can start to draw this line right about, I'll say here is a good point to do it, right about here. Let's take this all the way across, right about there. Okay. Now, let's take our line tool, and remember, we're gonna go from the neckline to the bottoms. So let's go here, bottom to the neckline. All right. Now we have our distance between the neckline and in this case, the double bottom. All right. Now that we have the distance, we're gonna duplicate this line, and now we're just gonna move it up to where it lines up with the neckline. The bottom of this line here is gonna line up with the neckline, right? So when we look over to the right, once we are starting to head to the upside and we break resistance, break the neckline, we can look to close our position when price action reaches the top of this line. So let's go to the right, and as you can see, even though it went a bit above this line, but it pretty much went to this line, and then as you can see, started to head back to the downside. So if you get in here, your entry, you want to ride this all the way up, and once you get into this zone, the top of the line, let's look to the right, once you get up into this area here, you should look to close your position and take profit just to play it safe. Even though it went up just a few more dollars and you could have made a little bit more money, always lock in profit. If anything, you set a stop loss right about here, and if you want to just let it play out to see if it'll go further for you, you can, but I recommend close your entire position and take full profit right here as soon as you get up into this zone. So it's the same thing as the double top, but we just flipped it now. All right, so just wanted to touch on that. And then also here, in every case, when you break through the neckline, there's not always going to be a retest of it, but sometimes it will retest. In this case, you see it did. It broke through, but came back down to retest the neckline and then proceeded to the upside. But this doesn't always happen. Sometimes it'll continue to go, it will just continue to go up sometimes, and it won't retest. So it's just something to keep in mind when you're in a play. It could retest or it might not. But either way it goes, I just wanted to touch on those two things for you. All right, we have the ascending triangle. Now this has a rising lower trend line and a flat upper channel line. This usually indicates that buyers are more aggressive than the sellers. We view this as a bullish pattern, and we would look to buy call option contracts. So let's look at that ascending triangle. So here is the rising lower trend line right here. And this is the flat upper channel line right here. So again, this suggests that buyers are more aggressive than sellers because you have higher lows. So this is a low, but this is a higher low. These are all higher lows right here, that when the touches happen to this trend line, when price action touches this trend line, you have higher lows. So that is what shows that the buyers are stronger. Okay, so at this point, I'm looking to take call positions anytime price action comes and touches this rising lower trend line. I'm not looking to buy in the middle. The safer entry will always be when price action touches this rising lower trend line. That's going to be your safest play. But at some point, you can expect price action to break above this upper line to the upside. We just don't know when it will happen. So it could happen here. It can happen all the way at the end, right here in this area. We don't know when, but either way it goes, we want to play call option contracts when price action touches this lower trend line here. So that's how you will want to play the ascending triangle. Now you may be asking yourself, well, can I play put option contracts when price action touches the upper line, because you are getting rejections? Yes, you can. You can play put option contracts because this line is acting as resistance. So you can play puts as well. All right. I prefer to play calls because this is a bullish pattern. However, some people will play put option contracts every time the price action touches the upper channel line. So that is possible. All right, so moving right along, another example of the ascending triangle, you have the rising lower trend line right here, and you have multiple touches. So this is why I prefer to play calls when the price touches the lower trend line, because every time it touched, the price went up nicely. And again, I'm looking for things to eventually break through this upper channel line. All right, so this is the chart this is ConocoPhillips. All right, this is the daily chart. So imagine you're a long-term investor or you're a swing trader, and you buy your call option contracts when price action touches the lower trend line, and then you hold those contracts, let's say for 2 weeks. So your expiration is 2 weeks away from the time you bought the contracts. So you have 2 weeks, right, for price action to go to the upside. So let's say you would have gotten in right here, and that level was at the $100 level. So if you would have held call option contracts, and let's say you would have cashed out right here. Now this is the $116 level. So that's a $16 increase in the price of ConocoPhillips. However, your options contract, we talked about the ask and the bid. You buy on the ask, sell on the bid. So had you gotten in down here, the bid price would have been increasing because the price of the ConocoPhillips stock increased. All right, so if the stock increases, your bid price increases for call option contracts. If you have put option contracts, as the stock price goes down, your bid price goes up. So you're always looking for the bid price to go up. But again, let's review it real quick. Just want to make sure you understand this. The bid price, you always want to see that number rise. For call option contracts, as the price of the stock increases, the bid increases for call option contracts. For put option contracts, as the price decreases, the bid price increases. So, all right, so I just wanted to touch on that real quick. Okay, moving right along. The symmetrical triangle. It displays sideways activity with prices fluctuating between two converging trend lines. This pattern is usually seen during uptrends, and it's as if the stock is just taking a break before it will continue its push to the upside. All right, you'll notice higher lows, which tells us that the uptrend is still in place. Let's take a look at that symmetrical triangle. Now, you have a declining upper channel line right here. And then you have a rising lower trend line right here. But let's take a look at what happened before all of this took place. You had a strong uptrend. That's important to note. A strong uptrend. Now price is moving sideways. All right. So what you want to do in this scenario, now price action could break this lower trend line, but being that we had a strong uptrend prior to the symmetrical triangle, I would look for price action to go and break above this upper channel line. But again, we never know. We never really know. But again, I'm looking to buy call option contracts anytime price action comes down and touches this line. So right here in the middle, this is where price action is currently. I'm not buying anything in the middle. I'm never gonna buy in the middle. We always need to wait until the upper line is touched if you want to play puts, but if you want to play calls, because again, previously we had a strong uptrend, so the buying is stronger in my opinion. So I'm going to play call option contracts once price action comes down and touches this lower trend line. All right, let's move forward. And Microsoft, look at this, a very strong uptrend, a very strong uptrend. All right, again, I'm looking to play calls because of the previous uptrend. So anytime the price action touches this bottom line right here, I'm going to look to get into call option contracts. All right, so key point, traders who want to play it safe will wait for the breakout to the upside or downside before entering a trade. So again, you can play call option contracts, and then when you get the break to the upside, it's safe. You can jump in once price action breaks through this upper line, or, you know, we talked about retests. Sometimes you'll get the break and then it'll come back down to retest the upper trend line and then push to the upside. So a lot of people like to wait for retests. Make that note again. A lot of people like to wait for retests. Sometimes they don't happen, but when they do, you'll be glad you did wait for them. Okay, so this is another example of that symmetrical triangle. All right, descending triangle. It displays sideways activity with prices fluctuating between two converging trend lines. Now, this pattern, it usually just calls for a trader to wait to see what will happen. The upside or downside momentum is possible with this pattern. However, it's overall considered a bearish pattern. Support is being held, so you have lower highs. And this tells us that there's no desire for the buyers to push that price higher, right? So let me show you the example on this right here. So you can see we have an almost flat lower trend line right here. So it's not really strong. It's not really, the angle on it is not really there. It's just it's almost flat. But you have a declining upper channel line, which is much steeper. So the sellers are really stronger in this situation. And with this pattern, I'm not looking to buy call option contracts when the price action touches the lower trend line. I'm looking to get into put option contracts in this pattern. And I'm going to get into those anytime the price touches the upper trend line, this right here, this line. Because as you see, every time it touched, it was rejected big time. All right, so for the descending triangle, I'm looking to get into put option contracts. And I only want to play the put option contracts when price touches the declining upper channel line. All right. Moving along to the rising wedge. This displays two upward sloping trend lines which converge to create higher highs and higher lows. This pattern shows that the buying momentum is slowing down and it's only a matter of time before price begins to move to the downside. Entering a position for put option contracts with this bearish pattern should only occur when a candle closes below the upward sloping lower trend line. Important to note. Let's take a look at it. Here we have the upward sloping upper trend line. And here we have the upward sloping lower trend line for the rising wedge. So to enter here, I only want to enter when a candle closes below this upward sloping lower trend line. That's what I'm waiting for. Now you can enter put option contracts here. that's possible. However, entering when you have a break in this lower line gives you more confirmation that it's bearish and price is ready to head to the downside. So I personally would rather wait for the break in this lower line. All right, that's just how I would play the rising wedge. And that's how I recommend you play the rising wedge. All right, so again, we want to wait for a break in this upward sloping lower trend line. That's going to be the better play right here. So for example, when price goes from here, comes down and breaks this lower line, all right, a solid break, then we can take positions into put option contracts. But again, even in this situation, a retest is possible and the price could break, come back to touch this lower line, and then head to the downside. All right. Another example of the rising wedge. Again, we have the upward sloping upper trend line here, and we have the lower trend line here. So I'm waiting for a break. Price action in this example is right in the middle. Again, I'm not taking any positions at all if price action is between these converging lines. I'm not taking a position. It's too high of a risk to do so. We want to wait for the break in this lower line. All right, next up, I've got a video for you, and I'll be right back. I want to touch on the rising wedge pattern. So here you have the upward sloping upper trend line, and here you have the upward sloping lower trend line. Right, now this is a bearish chart pattern, so we're looking for a move to the downside, and this is what happens. You have it rising up, these two lines are converging, but once we get up into this area, we will look for a break in this upward sloping lower trend line. So we're here currently. It could come down to this line and break this way, or it may go up a bit further and then come down. But before we take our entry, we want to wait for a break of this upward sloping lower trend line. Once it breaks, then we take our entry for put option contracts, because of course with put option contracts, we make money as the price declines. Now, I also want to touch on this. The expected move to the downside. When should you look to exit the position once you get in? And a good way to tell is you take a line here and you draw it from this point. So the widest point of this rising wedge, you're going to start at the top of the widest point, which is right here. This is the opening. So you take a line, go straight down, and you stop that line once you get to the upward sloping lower trend line. So you take the widest point of the rising wedge from top to bottom, and then you take this line, and once the price breaks this upward sloping lower trend line, once it does that, then you're going to place this at the point it breaks. So let's say, for example, it breaks the trend line right here. If it does that, you're going to take this line tool and you're going to put it right there. All right, there, okay, right there. So if it breaks right here, this is the move to the downside. This is the distance that you can expect it to go to the downside. So if it breaks here, we're gonna look for price action to drop all the way down to this zone. And that is where you will look to take profit and get out of your position. So I just wanted to touch on the expected move to the downside when it comes to the rising
wedge pattern. So that's all you do. Draw a line from the top of the widest opening to the bottom of that wide opening, and then apply it to the point at which price action breaks this upward sloping lower trend line.
All right, on to the falling wedge. The falling wedge displays two upward sloping trend lines which converge to create higher highs and higher lows. This pattern shows that the sellers are losing momentum and the buyers are gaining strength to slow the stock's decline. Entering a position for call option contracts with this bullish pattern should only occur when we get a break, a close below the trend line. All right, so here we go. I'm sorry, a close above the trend line, not below. For the falling wedge, we want to see it close above. So we have our upper trend line here, our lower trend line here. Now you see this strong green candle, and now this is all volume down here. So we had strong volume backing up this candle right here. Strong push to the upside through the upper trend line. When this happens, we can expect price action to continue to head to the upside. Now again, it could come back down to retest this upper trend line, but maybe it doesn't. Maybe it continues. But we're currently right here in price, so it could very well come back down here. However, we may continue to head back to the upside. But for the falling wedge, it is a bullish pattern. So overall, we do look for price to continue to push upward. And typically with this pattern, when price action does head to the upside, it goes up big time. It doesn't go up just a couple dollars. It goes up, I would say, pretty significantly. It goes up. All right, so that's the falling wedge. We want to wait for the break to the upside through the upper trend line. And at that point, we can look to start taking our entries for call option contracts. When we see the volume increasing to back up the move, it gives us even more confirmation that price is ready to head to the upside. The head and shoulders pattern. It displays three peaks, and it does suggest that we're gonna go from bullish to bearish. All right, so similar to the double top, but the head and shoulders pattern looks different. Now, just as with the double top, you're looking to take a position with put option contracts because this is a bearish pattern. All right, let's take a look at this pattern right here. Head and shoulders. So we have the left shoulder forming right here. This would be the head, and this would be the right shoulder. Now you can see we have a touch here and multiple touches here, which forms the neckline. So you can see it's very similar to the double top, except here you have three peaks: a left shoulder, a right shoulder, and a head. Three peaks. Once this neckline is broken, we look for a candle to close below the neckline. Maybe even two candles, just to give us even more confirmation. At that point, we can look for a move to the downside. And again, a retest can happen here to where we break through, we come down here, we move back up slightly to retest the neckline, and then price action could continue to go down from there. Okay, so this is the head and shoulders pattern, and we will go into a video, and I'll be right back.
Okay, I want to touch on the head and shoulders pattern and when you could look to enter and the expected zone in which you would look to exit the position. So you see here, you have your left shoulder is formed, your head is formed, and the right shoulder as well. and we would not by any means enter a position until this neckline is broken after the right shoulder. So you got the right shoulder here, price action is going down, but as you see, it hasn't broken this neckline yet, so we would not take a position. So as soon as it does, as soon as it breaks and you get a candle that closes below the neckline, preferably even two candles that close below the neckline, then you can have a better feeling about price action continuing to the downside. When it goes to the downside, let's take our tool here and draw a line. So this line is going to be from the top of the head all the way to the neckline. Once you've drawn that line, then let's say price action breaks the neckline right here. You're just going to take this line and move it right to that area. Match it up. So as soon as that candle breaks below this neckline, you're going to make a line from the neckline on down. And this is how much of a distance, this is how much of a drop we can expect. So once price action starts to go down, we would look to take profits in this zone. You don't have to always wait until it gets to the very, very bottom of this line. We can look at the zone. So anywhere in this area, you can look to take profits. So this is the expected drop once a candle or two breaks this neckline.